Welcome to Burkenroads Reports continuing coverage of the First Bancshares Incorporated. My name is Cade Hanson, and my fellow analysts are Cole Spanierman, Mia Provenzano, and Jack Friedman. The investment research manager of this report is Matthew Bullock. We conducted this research at Tulane University's A.B. Freeman School of Business. To give a quick agenda of the presentation, first, we'll be taking a look at our investment rating for the First Bancshares, followed by a graph of the company's 5-year stock performance. Then, we'll give a brief company overview, our investment thesis, our peer analysis, and finally, we'll finish up with our valuation methods that we use, along with some of our forecasting assumptions. The First Bancshares trades on the NASDAQ under the ticker symbol FBMS. Its stock price as of April 2nd, 2019 is $30.99. Our 12-month target price for the first is $37, with a market rating of market outperform. Here, you can see the first's 5-year stock performance. The first stock has ranged from $15 per share to a high of just over $43 per share and currently sits at $30.99. Over the last year, the stock reached a low price of $27.85 and a high price of $43.53. The First Bancshares was founded in 1996 and is headquartered in Hattiesburg, Mississippi. The First currently has 61 full-service branches spanning across Mississippi, Louisiana, Alabama, Florida, and Georgia. The company began trading on the NASDAQ on May 5, 2004. The First prioritizes real estate and commercial loans, which make up 95% of its total loan revenue. In 2009, the company implemented its tri-state expansion strategy, which has successfully allowed the First to expand rapidly through organic and inorganic growth, which has helped it become the 6th largest bank in Mississippi. Under the 5-year plan for its tri-state expansion, the First has been strategically acquiring assets in growing areas of Mississippi, Alabama, and Louisiana. Since the First began the plan, it has grown from 10 branches and $477 million in assets at the end of 2009 to 61 branches and over $3 billion in assets as of December 31, 2018. The First has acquired 5 banks within the last 2 years alone, which has helped them see rapid growth and expand into the Florida and South Georgia banking markets. The First will likely continue to strategically acquire banks throughout the region moving forward. The First has consistently seen increasing loan growth and revenues from interest over the past 5 years. Acquisitions have played a significant role in this rapid growth and have helped them increase their presence in a competitive market environment. Expansion into new markets with high growth prospects, such as Florida, presents significant revenue opportunities for the First moving forward. While acquisitions play a large role in this growth, the First has also seen significant organic growth. The First organic loan growth rate has remained strong at 10.6% annually for the last 5 years, which is far above the industry average. Led by a strong and experienced management team headed by Ray Hoppy Cole and D.D. Lowry, the First Bancshares will likely continue to increase market share as well as expand into new markets if the opportunity presents itself. Now, we will provide an analysis of some of the First Bancshares peers. All of these companies are regional commercial banks positioned throughout the Southeast. They all offer similar services to the First and have similar market capitalizations. Compared to its peers, the First is above average in ROE, return on equity, EV or enterprise value, EPS or earnings per share, and market value. However, the First is below average in net interest margin, net charge-offs to average loans, dividend yield, and debt to equity. In order to reach our 12-month target price of $37, we used 3 different valuation methods and weighted them equally. First, we used a discounted cash flow, which is calculated by taking the present value of future cash flows and discounting them to the valuation date. We calculated a weighted average cost of capital of 7.024% and added a liquidity risk premium of 1.5%. We assigned a terminal growth rate of 2.6% based upon the recent U.S. GDP growth rate. This analysis yielded us a target price of $38.61. We also used two different valuation multiples methods, which include current price to earnings and current price to tangible book value. Current price to earnings compares a company's price to estimated future earnings. We assigned a PE multiple of 18.8, which gave us a fair value price of $37.31. Current price to tangible book value compares a company's current price to its forecasted future tangible book value. We applied a P to TBV multiplier of 1.18, which yielded us a fair value price of $36.18. As the main driver of our revenue model, the team decided to use net interest income from loans. Using historical data from the last 5 years, we calculated an organic compound annual growth rate of 10.603%. We also assume that interest expense will grow at the same rate as interest income. Another key assumption is that interest rates on customer deposits will remain constant moving forward. Also, it is critical to mention that in order to accurately forecast future earnings for the first, we had to factor inorganic growth from acquisitions out of the model, as it is impossible to accurately forecast future acquisitions. That concludes our presentation. Thank you very much for your time. For more information on the First Bank shares and continuing coverage of other companies, please visit www.burkenroad.org.